Hey everyone, welcome back to Corporate Decoder, the place where we find the hidden stories in corporate filings, and this report might just tell a tale of ambition and some very interesting financial gymnastics. So today we are diving into a Form 8K from A Acquisition Corp, filed on the 23rd of January 2026. Now, this isn't your typical quarterly report full of detailed financials, but rather an announcement of a significant event, a business combination. Think of it as a company announcing its marriage to another company. The main event here is A Acquisition Corp, also known as A, which is a special purpose acquisition company, or SPAC for short. SPACs are essentially shells created to merge with or acquire existing private companies, taking them public without the traditional initial public offering process. So A is announcing its agreement to combine with Hecate Energy Group LLC and its parent Hecate Holdings LLC, which we'll call the Hecate parties. This is a big deal for both sides. Hecate gets to become a publicly traded company, and A fulfills its purpose of acquiring a business. The document outlines the business combination agreement signed on the 21st of January 2026. It's a pretty complex set of maneuvers. First, there are a few steps involving shareholder redemptions and conversions. Basically, existing shareholders of A can choose to redeem their shares, and certain other securities, like convertible notes, are either converted or exchanged. Then comes a significant structural change. A Cayman Islands exempted company will change its domicile to Delaware in the United States. This process is called a domestication. After this, it will be a Delaware corporation, and its name might even change to something Hecate chooses. This move to Delaware is common for companies looking to operate within the US legal and regulatory framework. Following the domestication, A will contribute all its assets to Hecate. In exchange, Hecate will issue units to A, and the Hecate parent company will end up holding shares in A. This sounds a bit like a circular transaction, but it is a standard way to structure these SPAC mergers, creating what's known as an Up-C structure. What this Up-C structure means for investors is that Hecate, the actual operating company, will be managed under an amended and restated limited liability company agreement. This agreement is important because it outlines things like how holders of Hecate units can redeem those units for shares of A, typically on a one-for-one basis. It also sets up mandatory redemptions in certain situations, like a change of control. There is also a tax receivable agreement, or TRAG-A. This is a bit technical, but basically A will pay Hecate's owners 85% of the tax benefits A gets because of the increased tax basis in its assets resulting from the share exchanges. It's a way to share the tax advantages of the deal with the original owners of Hecate. Now let's talk about the people who helped make this happen, especially the sponsors. There is a sponsor lockup and support agreement. This is where the original investors or sponsors in A agree not to sell their shares for a certain period, usually a year after the deal closes. This is to prevent a flood of selling pressure that could hurt the stock price. They also agree to vote their shares in favor of the deal, and there are specific conditions under which their shares will become vested, meaning they can eventually sell them. These vesting conditions are tied to the stock price hitting certain targets like $12 or $13 on average over a period of time, and even to the amount of cash remaining in A, its trust account after redemptions. If these price targets aren't met within 4 years of the closing, any unvested shares are forfeited. This aligns the sponsors' incentives with the long-term success of the combined company. Similarly, there is a parent lockup and support agreement for Hecate Holdings LLC. They also agree not to transfer their newly acquired shares for a year after the closing, and with some provisions for transferring limited amounts after 6 and 9 months. The financial tables in this filing are quite minimal since it's an 8K reporting a business combination. There aren't detailed profit and loss statements or balance sheets here. Instead, the focus is on the agreements themselves. The most significant financial implication comes from the expected outcome of the deal, which is to combine A trust account funds with Hecate's operations. A key condition for the deal to go through is that the aggregate transaction proceeds from A's trust account after redemptions and expenses must be greater than or equal to $50 million. This $50 million threshold is a crucial number indicating the minimum cash needed for the deal to be viable. This filing also mentions a press release issued the day after the agreement was signed. These press releases are often more promotional, but they serve to inform the public and investors about the announced deal. They usually highlight the perceived benefits of the merger and provide a positive outlook. The filing includes important disclaimers about forward-looking statements. These are statements about future events or performance that are subject to risks and uncertainties. They are essentially telling investors, look, we're excited about this deal, but things could change, and we're not making guarantees about the future. They also emphasize that this filing is not a solicitation for votes or an offer to sell securities, but rather information about the proposed business combination. Investors will need to carefully review the more detailed proxy statement prospectus that will be filed with the SECSO. What is the story here? A. Acquisition Corp. A SPAC is merging with Hecate Energy Group. This is a major step for Hecate to go public. The deal has several intricate steps designed to restructure the companies and align incentives. The financial aspect that matters most to investors right now is that the deal needs at least $50 million in cash from AS Trust account to close. The sponsors are locked up for a year, and their performance incentives are tied to the stock price and the cash available. This structure aims to ensure the sponsors are motivated to see the combined company succeed. Looking at this from a strategic perspective, A is essentially using its capital raising abilities to bring Hecate to the public markets. The C structure is a common strategy that allows existing owners to benefit from future tax advantages while still providing liquidity for public investors. The lockup periods for sponsors and parent are standard practice for SPACs to signal confidence and prevent immediate selling pressure. The biggest risks for investors at this stage revolve around the SEC approval process shareholder approval and whether the minimum cash condition of $50 million will be met. If redemptions are very high, A might not have enough cash to proceed. Another key factor will be Hecate's actual business performance as a public company and whether it can meet the performance targets that unlock the sponsor's shares. In conclusion, this filing is an announcement of a material event, the impending business combination between A and Hecate. It is a complex transaction with various agreements and conditions. The success of this merger will ultimately depend on Hecate's ability to perform as a public company and meet the expectations set by its new structure and its investors. What is your take on this SPAC merger and the Up-C structure? Do you think Hecate has a bright future? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you in the next one.